Yesterday felt like a total apocalypse. Screens bled out, deep red confidence vanished into thin air, and silver did exactly what it does when fear peaks. It punished true conviction. In mere hours, prices crashed from euphoric highs, erasing billions in paper gains and twisting certainty into doubt. Many of you stood frozen, staring blankly at charts, fingers hovering over that sell button, asking the one question traders have asked forever: is this truly the end? But today isn't about fear. Today's about finding clarity. Because while most folks were watching headlines and emotions spiral, the market itself was making a huge decision. When the session opened, silver didn't continue falling into chaos. Selling slowed. Panic lost momentum completely. And at one very specific price, everything changed. That critical price was $75. Not $70, not some arbitrary midpoint. $75 became the line where fear exhausted itself and discipline stepped in. This wasn't random. This was structure asserting itself. This was intent. And this is the moment rookies see disaster while professionals recognize a valid test. True breakdowns don't hesitate. They slice through support without resistance. What we witnessed instead was a violent shakeout followed by a precise defense. The kind of move designed to force weak hands out while quietly transferring ownership to stronger ones. This is how bull markets cleanse themselves without ever collapsing. Crashes destroy structure. Corrections reinforce it. And what formed at $75 wasn't a crack in the foundation, but a deliberate confirmation that the trend is still alive. If you understand why $75 mattered yesterday, you begin to understand why this move is not finished. The market spoke clearly. Most people just were not listening. Before we go deeper, if this analysis is helping you see the market more clearly, support the channel by subscribing and drop a comment with one if you held through the volatility, or two if yesterday shook you out. Now let's move forward, because understanding this floor is the key to everything that comes next. To understand why $75 held with such precision, we have to step back and look at history, not headlines. Markets have memory. Price levels are not just numbers on a screen, they are zones where battles were fought, capital was committed, and psychology was shaped. And the $75 level carries more memory than most people realize. Go back to the early phase of this rally. Before silver ever exploded toward the highs, it spent weeks trapped below $75. Every attempt to break higher was rejected. Sellers defended that level aggressively. Volume piled up, frustration built. For a long time, $75 was the ceiling that refused to give way. Then when silver finally broke through it, everything changed. Momentum accelerated, sentiment flipped, and price left that zone behind with force. That breakout was not just a move higher, it was a regime change. And in technical markets, there is a rule that never stops working. Old resistance becomes new support. This principle is not theory, it is behavior. Traders who sold at $75 before the breakout regret it. Traders who bought the breakout defend it. When price returns to that level, both sides act at once. Sellers hesitate. Buyers step in. The market stabilizes. That is exactly what happened yesterday. The sell-off did not stop randomly. It stopped at the scene of the breakout. The market came back to test whether that level still mattered, and when it did, it held. This is what professionals call a retest. Retests are not bearish. They are essential. They confirm that a move was real. Weak trends fail retests. Strong trends pass them. While emotional traders saw a collapse from the highs, disciplined traders saw something entirely different, price returning to a structurally important zone where large players were waiting patiently. The ones who did not chase euphoria. The ones who plan entries weeks in advance. This is why context matters. Without it, every pullback feels like a crash. With it, corrections become opportunities. And this retest at $75 was not subtle. It was aggressive fast and defended with conviction. Which tells us one thing very clearly: the market still respects this level. But price memory alone does not build a floor. To truly understand the strength of this defense, we now have to look beneath human behavior and into the machinery that actually moves markets today. Price doesn't move on emotion alone. In modern markets, it moves on math. More than half of all transactions are executed by machines that do not feel fear, hope, or regret. They respond to predefined levels, probabilities, and statistical triggers. And yesterday, silver collided with one of those mathematical boundaries almost perfectly. This brings us to Fibonacci retracements. Many dismiss them as superstition, but the reality is simple algorithms are programmed to respect these ratios. When a strong trend pulls back, the machines look for specific retracement zones where probability favors a reversal. The shallowest and most aggressive of those zones is the 23.6% level. When you measure the entire rally, from its November lows to the recent peak, that 23.6% retracement sits just below $75, and yesterday's low stopped just above it, not by dollars, by cents. That detail matters. In weak markets, price blows straight through shallow retracements and searches for deeper discounts. It falls to the 38.2% or even the 50% level before buyers appear. But in dominant trends, price barely corrects at all. Demand is so strong that buyers step in at the first mathematically acceptable opportunity. That is what we saw. The market did not allow silver to fall into deeper retracement territory. Buyers front-ran the level. They paid up to ensure execution. That behavior is not fear, it is urgency. The same story appears when we look at moving averages. The 20-day average, which represents the recent consensus price, sat well below yesterday's low. In a normal correction, price returns to that mean. Yesterday, it never came close. It floated above it. This phenomenon is called front-running the mean. It happens when institutional capital is competing for exposure and refuses to wait for perfect prices. They would rather pay a premium than risk missing the trend entirely. When price holds above key averages and defends shallow retracements, it tells us something critical. The trend is not slowing down. It is compressing energy. The machines saw their signals, the funds saw their models confirm, and together they reinforced the same conclusion at the same level. $75 was not defended emotionally. It was defended mathematically. But math alone does not hold a market. To see how deep this floor really goes, we now have to look at the one thing that cannot be faked: volume. Volume is the truth serum of the market. Price can be manipulated in the short term. Narratives can be spun, but volume reveals intent. It tells you where real commitment exists and where it doesn't. And at $75, the volume profile tells a story that is impossible to ignore. Over the last several months, the heaviest concentration of trading activity sits directly in the $75 zone. This is what professionals call a high-volume node. It represents an area where millions of contracts changed hands, where positions were built, defended, and emotionally anchored. When price returns to a high-volume node, it does not move freely. It slows down. It gets absorbed. That absorption is exactly what we witnessed. Selling pressure hit the $75 area and began to disappear. Not because sellers suddenly felt optimistic, but because there was nothing left to sell into. Every wave of supply was met with demand. Think about the two groups trapped at this level. The traders who bought around $75 earlier in the rally watched price explode higher. When price collapsed back to their entry, they were not afraid. They were relieved. Their instinct was not to sell, but to defend. At the same time, traders who sold or shorted near $75 months ago had been suffering. They watched price run away from them. Yesterday, the market handed them an escape. They bought to close. That is buying pressure born from regret. When buyers defend and sellers cover at the same level, price becomes sticky. It turns into a sponge that absorbs selling without collapsing. This is why massive sell orders can hit a high-volume node and barely move the market. This is not magic, it is mechanics. Regret on one side, conviction on the other, both expressing themselves through volume. And when a market absorbs pressure instead of breaking it, signals strength. Weak markets collapse under stress. Strong markets digest it. The defense of $75 was not quiet. It was heavy, contested, and decisive. That tells us this level is not fragile. It is reinforced by memory, by capital, and by emotion. But even volume does not tell the full story, because while price was stabilizing, something critical was forming on the chart itself, a signal that traders have respected for decades. To understand whether this was truly the end of the selling, we now have to look at the shape of the battle. Markets leave footprints. When buyers and sellers clash, the outcome is written directly onto the chart. And yesterday, at the exact moment silver tested the $75 floor, the price action carved one of the most recognizable reversal signals in technical analysis. A classic hammer candle just hit the daily chart. It's a basic setup, yet incredibly potent. The spot price opens weak, the TAMP team drives it down, and fear spreads. Then the game flips. Stackers step up, soak up the paper supply, and push the metal back near session highs. You're left with a long wick and a tight body up top. It's undeniable proof of a bottom rejection. The shiny followed that script perfectly. Bears smashed the bid, trying to crack the floor and spark a liquidation. It didn't work. Every dip was bought up by physical demand. By market close, the metal clawed back almost all the losses, sending a loud message: cheap silver is not for sale. A hammer in no man's land is noise. A hammer at major support is the gospel. When this setup prints right on a heavy floor, it screams that the shorts are out of ammo. They unloaded their entire clip to suppress the price and still couldn't hold the line. The momentum charts tell the same tale. The relative strength index never even dipped into oversold zones. Instead of crashing to weak levels, it held the line in bullish territory. That proves smart money was stacking early, not sitting around waiting for a clearance sale. You only see this action in legit bull runs. Weak markets need a total crash to lure in buyers. Strong markets pull in stacking demand while momentum is still running hot. Digging deeper, the volume backed it up. Selling dried up as spot neared $75 while buy orders piled in on the bounce. This is textbook accumulation. The big boys let the panic burn out the weak hands, then they quietly scoop up the goods. When candle structure, momentum, and volume all sync up at one level, the odds flip. The chance of a continued dump drops, and the likelihood of a hard floor and reversal skyrockets. This wasn't a dead cat bounce, it was a hard no. But charts alone don't cut it. To know if this floor is real, we need to ID the actual buyers. Markets don't pivot on pretty patterns. They turn on serious capital flow. To get the truth, we track the liquidity. Tracking the cash strips out the emotion. Charts fail, gurus lie, but money talks. And right at the $75 mark, the intent was obvious. They were stacking, not fleeing. As spot leveled out, selling vanished while smart money quietly returned. This split matters. When price holds as volume builds, the silver is changing hands. Weak hands fold under pressure. Strong hands enter on purpose. Whales need liquidity to fill their vaults, and panic delivers it. Yesterday's TAMP created the exact setup they hunt for. Retail panic sold their stacks. The big players soaked it up patiently. Crucially, these weren't paper traders. They were industrial buyers. Tech firms needing silver for chips don't gamble on momentum. They manage supply shortages. As premiums rose, they waited. Below $76, the math made sense instantly. That's the industrial floor. When silver hits the buy zone, physical orders trigger. Factories can't sit around for a pretty chart. Securing the metal matters more than timing. Meanwhile, the commercial banks cut their shorts. These guys usually hammer the rallies. When they stop suppressing the price, it signals the bottom is likely in. Investor flows leveled out. Industry started buying. The banks backed off. Three massive forces collided right at $75. This support wasn't emotional, it was structural. But even solid floors get tested, especially when the danger comes from outside the pit. And the next hurdle has nothing to do with the metal itself. It comes from the macro scene. We have to face the risk still looming over the stack because no bull flag exists in a vacuum. Even the best charts get stress tested, and the biggest threat to that $75 floor doesn't come from the silver market itself. It stems from macro pressures. Silver lives in the shadow of the fiat dollar. When macro news drops, algos seize the wheel. In those moments, the price action is robotic, not human. Funds shuffle assets, models tweak, and silver can swing wildly without any shift in the real fundamentals. A hawkish Fed can spark a violent dollar rally. If that hits, silver might face another brutal support test, not because the floor is soft, but because the algorithm flows swamp the chart. This is how you get those sudden tamp downs even in a bull market. These moves usually paint fake breakdowns. Spot dips under support, stops get hunted. Leverage gets wiped and panic sets in, but without momentum, the tamp fails. They're designed to shake out the weak hands, not crash the system. The key factor is acceptance. Floors don't break on daily chop. They only fail if price sets up camp down there. Sharp stabs that snap back don't kill support. They actually make the foundation stronger. As long as the metal doesn't camp under $75, the trend is alive. Volatility isn't a death sentence. It's just a stress test for your position. If macro headwinds die and the dollar stalls out, the runway clears fast. The energy coiled up during this consolidation only has one way to explode upwards. To see where that explosion heads, we shift from defense to mapping the upside. With the big risks flagged, let's look ahead. The market doesn't pay you just to spot danger. It pays you to know where price goes when the smoke clears. And when a solid floor holds the line, the next leg is rarely just a random coin toss. First spot needs to retake the mid-range resistance right above the chop zone. That's where the trap shorts will try to bail out. As price climbs, their panic becomes rocket fuel. Every tick-up forces more covering, juicing the momentum. Once that zone breaks, eyes lock on the old highs. Highs aren't walls forever, they're magnets. After a brutal shakeout, the metal often rips back to the top faster than you think because the weak hands are gone and the hodlers are strong. This bounce doesn't need hype. It just needs calm. When fear dies and the price stops looking scary, the sideline cash piles back in. That flow alone can send the spot price ripping higher. The chart structure now supports this path. Higher lows are locked in. Momentum is still hot. Stackers have shown they'll buy the dip early instead of waiting for a total washout. This builds a stair-step pattern. Sellers hit buyers at higher levels. The floor lifts. What started as defense turns into a launch pad. But targets aren't guarantees, they're odds. The market still moves in waves. Dips happen. But as long as they stay shallow and get bought up, the trend is unbroken. Knowing this builds discipline. It stops you from FOMOing the top or panic selling the noise. With the roadmap set, we need to zoom out and grab the lesson this market is teaching. The gap between winning and losing is rarely about the specific trade itself. It's how you handle the volatility. Every big move teaches something, and the recent dump was no exception. This wasn't just a correction, it was a mind game designed to separate the reactive from the disciplined. How you handled it says way more about your future stack than the result of one single trade. Volatility reveals character. When spot crashes hard, fear warps time. You feel the urgency. Your brain flips from logic to survival mode. This is where most get wrecked, not from being dumb, but from having no plan. Without a system, every red candle feels like a personal attack. Pros handle the chop differently. They expect it, they prep for it, they know strong trends need some violence to wipe out leverage and kill the hype. Without these shakes, markets get brittle. Corrections aren't bear markets, they are the engine that keeps the bull run alive. The lesson from the $75 hold is patience under fire. The market tested your gut right when doubt peaked. Those who knew the game saw a discount. Those who panicked just became liquidity for the big whales. It ain't about being right or wrong, it's about positioning. The winners don't predict every tick. They just survive the chop without blowing up their stack. That takes defined risk respect for the levels and staying cold to the short-term noise. Another lesson is true selectivity. Not every spot dip is a buy, not every rally is strength. Context determines meaning. A smash into structural support during an intact trend is not the same as a breakdown from distribution. Knowing this distinction separates stacking from gambling. Markets reward preparation, not prediction. And this smash reinforced a timeless truth. The hardest moments to hold on to your stack are often the most vital ones. With that insight, we can now step back and view the bigger picture. Not just where silver spot might go next, but how to navigate stacking in markets like this moving forward. This brings us to the final chapter of the stack. What occurred at 75 fiat dollars was more than a technical reaction. It was a lesson in how markets truly operate. Spot price does not move randomly. It reflects structure psychology and capital interacting under pressure. When you understand that volatility stops feeling chaotic and starts becoming information. The first strategic takeaway is simple. Strong bull markets do not collapse easily. They test conviction, shake weak hands, and intimidate stackers, but they do not abandon structure without resistance. When a floor forms through multiple confirmations, it deserves pure respect, not blind faith. The second lesson is discipline over prediction. You do not need to call exact tops or bottoms. You need to define risk. Levels matter because they tell you where you are wrong. Without structure, every spot move feels dangerous. With it, uncertainty becomes manageable. Third, patience is a competitive advantage. Most stackers fail not because they misread direction, but because they cannot tolerate the discomfort. Markets are designed to punish impatience and reward solid preparation. Corrections are not enemies of the silver stack. They are the cost of participation. Upside requires volatility. There is no reward without friction. Silver's defense at 75 fiat notes revealed where conviction lives. Your task is not to predict the future, but to align with structure and manage your risk intelligently. If this analysis helped you, please support the channel. Subscribe, like, and share. Comment 1 if you kept stacking, or 2 if this move taught you something truly valuable. Stay prepared, stay patient, keep stacking.